Dear admission team, my name is Juisen Chang, and today I'm going to present my finance topic report, a stock pitch on TSMC. I'll begin with a company overview, followed by my investment thesis. Then I will discuss the risks and mitigants. Finally, I will present my valuation analysis using a DCF model and conclude with my investment idea. Let's get started. So TSMC is the world's largest semiconductor foundry, holding over 60% market shares in the chip manufacturing industry. Its key customers include Apple and Nvidia, while its main competitors are Samsung and Intel. Its main revenue sources are high-performance computing, including the AI data center, and TSMC steadily achieved 20% and more annual revenue growth over years. The first investment thesis is that its dominant is in technology, since high-end customers prioritize reliability over cost. Its high yield rate helped it to secure over 60% market share over the years. This edge is also reflected in financials. The high gross margins show how competitive its products are. Besides, the DuPont analysis reveals that its high ROE is driven by strong net profit margins rather than their financial leverage. This shows TSMC excel in leverage shareholder capital to drive returns. Given its consistent increase in R&D and CapEx, this advantage will remain sustainable. So in valuation, I assume TSMC has an above average free cash flow growth in the past case. The second thesis is strong AI demand. Looking at the AI industry value chain, AI applications rely on cloud service providers to train their models. At the core of these are the chips that are made by TSMC. So, how big is this market? The AI capex of CSP is expected to reach 600 billion in 2030s, and a massive portion of this investment is allocated to AI semi. More specifically, the AI semi market is projected to grow at a 34% CAGR. To reflect AI in valuation, management revealed that AI sales will account for 25% in 2025 and exceeds 20% within the next 2 to 3 years. And it will double in this year and grow at a CAGR of 45% in the next 5 years. The revenue growth will also remain a CAGR of 20% in the same period. There are still some risks for investing TSMC. First one is export control risk. However, its global expansion will reduce dependency on any single region and ensure supply chain resilience. The second one is industry cycle, but its AI-driven growth will provide long-term stable demand. To estimate the intrinsic value, I use the DCF with bear, base, and bull cases under the following assumption. The discount rate, WACC, is based on the capital asset pricing model. In the model, I start with revenue projections and calculate net paid. Next, I adjust for non-cash items to derive unlevered free cash flow. Given the volatile working capital dynamics, I focus change in account receivable, accounts payable, and inventory to better reflect industry-specific fluctuation. Then I compute the present value of cash flows and use the prefetcher growth model to estimate terminal value. Finally, I subtract net debt from the EV to derive an equity value, and then arrive at TSMC's implied stock price under different scenarios, as you can see in the below table. To conclude, from both valuation perspectives, TSMC's current stock price presents an attractive upside while having a low downside. For the EV/EBITDA multiple, I use a 5-year historical average as a lower bound, and the industry average as the upper bound to ensure a fair valuation range. For the DCF model, given TSMC's leading position in the industry and the surge of AI, I maintain a strong buy for TSMC in the best case, with a 12-month price target at $254 per share and a 22% upside. The bottom right table is my allocation recommendation for different investors. Thank you for your attention.